everyone, Luke Gromen, FFTT. Hope you are well. I apologize for starting a couple minutes late. Was finishing up a lift a little bit ago and had a hard time cooling down a bit. So didn't want to jump on here looking like I just been running in the rain. So I apologize, a couple minutes behind. At any rate, I hope everyone had a great Mother's Day yesterday. Enjoyed it with your mom or significant other or that special someone. And so we're going to jump right in here on a Monday night. A couple questions here. First from TGM, how long until official yield curve control, or YCC? That to me is the $64,000 question. I think the frame, there's no easy way to say, hey, this is the date. I think the best way to answer the question is to think about it in terms of frameworks. And what I mean by that is I think it first depends on the pace of certain economic developments, so the opening, inflation, etc. Then I think it depends on political developments in terms of do we start pulling back on unemployment benefits, or do we leave them those in place? Do we do more stimulus? What does that political environment look like on top of the reopening over the next several months? And then I think depending on those two factors, it depends then on when the bond market, effectively when a quorum of the bond market begins to realize, depending on how those two things develop, begins to realize that it's the proverbial frog in the pot of boiling water and decides to try to jump out. And that's the moment, that loss of confidence, where I think you're going to see us move from to yield curve control, YCC, very quickly. I continue to think maybe the most important thing to this framework is that it seems to my eyes, and as best I can tell, most economists and strategists are looking at developments as it relates to the Fed's balance sheet, etc., as likely to continue to develop linearly. And I think that's right up until that's dead wrong. And once confidence is lost, things will get very nonlinear very fast. And so that's the framework how I'm thinking about it, and so I share that with you as just so as we're watching signposts. If stimulus gets really pulled back, that moves us back from the edge of yield curve control. If we have hot inflation readings and we do more big stimulus on top of that, then that's going to move us closer to that moment where some quorum of the bond market says we're out of here. So. Second question is JSB. You and Michael Burry differ on whether or not hyperinflation will occur. He's a smart guy. Why is he wrong in thinking it'll happen? He's a very smart guy. I think the difference here between he and I is, in my opinion, we're not going to get a currency-destroying hyperinflation of the sort that we saw in, say, Zimbabwe or in Weimar Germany after World War I. And the reason I think that is because at the right price, we can make everything we need. That was certainly not the case in Zimbabwe, and in a real way, it was not the case in Germany. So, for example, in the United States, the dollar collapsed by 90% against oil from 1998 at $10 a barrel to 2008, $150 a barrel. And the aftermath of that is we had this massive growth in U.S. shale supply. Another example, if lumber keeps doing what it's doing, there is a price of lumber where I would have to consider ceasing to conduct research and go out and start cutting down the oak trees I have on our property and selling them for wood because it would be more profitable. So that's the type of the thought process. Now, there are certain sectors where that would happen on very much a lag. In terms of, for example, let's say semiconductors, you need to build the capacity. It's not easy to build it. It takes time, etc. So there would be a period of time where the inflation could be quite steep and severe, but I don't know that it would get to be currency destroying. A wild card in this where you could conceivably have a currency destroying hyperinflation in the U.S., and I don't want to speak for Michael Burry because I don't know if this is his case, but it would be if you had a complete societal breakdown of the systems and protection. So basically, your supply chains broke down, police stopped coming to work, you couldn't get stuff. Then you probably could go through a period of currency-destroying hyperinflation. But again, even then, for a period of time, at some point, systems get rebuilt. To me, you have to have a very dire outlook to get to a complete currency-destroying hyperinflation in the U.S. So I don't know what he's looking for, but that's ultimately, it's that ability for the U.S. to produce whatever it needs at the right price that I think prevents things from getting absolutely crazy to the point of a hyperinflation. I just think we're in for a period of pretty severe inflation secularly over the coming years. From Cabs, why hasn't gold and silver lifted like almost all the other commodities? I think it has a great deal to do with how financialized gold and silver are. They are highly tied to real rates in the United States as a result of all the financialization of gold and silver over the last 30, 40 years. And so real rates have bounced off of the lows since August of last year on expectations of a recovery. In the meantime, there's been a transition over to other commodities that would be used in said reflationary recovery. And so kind of the traditional playbook for recoveries when you come out of a recession is you sell gold as real rates rise and you buy productive commodities with a lower stock to flow ratio. And that's the trade we've seen. And the thing I think that most players are not factoring in properly is that this cannot be a normal reflation because the U.S. debt to GDP is at 130%. And if rates get too high, it blows up the government. This has not been true in the United States in 80 years at least. And so nobody alive has traded the last time we had a cycle like this. And that's why, ideally, if I was the perfect trader, I would have traded gold better, where you sell it when real rates start bottoming, you move it all over to commodities. We've liked commodities not as much as we've liked gold. That's been something absolutely could have done better in terms of positioning. However, my view has really been on this point that this is not going to be, in all likelihood, like the cycles of the last 70 years. Real rates, I think, are going way lower, and it's just not a trade I wanted to get cute with, because if real rates go way lower to inflate our way out of our debt, gold is not something you want to be selling at any point in that cycle, in my view, other than as a trade. So I think that's what we've been watching. In addition, I continue to hear physical gold markets and silver markets are tight. And so it's really tough to get too bared up on gold and silver when you're hearing physical markets tighten the way they are. But I think it's really around that financialization and just this narrative that, hey, we're in a reflation, we're in a recovery, and that's what you do. You sell gold, you buy commodities. So, and then the last question for tonight from Maurice. What metrics can be developed to gauge if newly implemented Bitcoin and Ethereum futures are suppressing price? At what point will unfutured coins like Dogecoin, Litecoin, Bitcoin Cash, etc. become the new fire alarms? It's a great question. It's tough to tell, in my opinion. I think ultimately, here too, I think the best way to think about it is in terms of pathways. I think the key to getting to a point where futures start having the potential to impact is if you get to the greater the depth, the more they have an ability to impact the underlying, in my view. I think the other point too is if you have other instruments, particularly if they are cash settled sort of ETFs, which really aren't out there that much, I don't think, but that's something to watch for. And then I think as well, centralization. If you start seeing a lot of the Bitcoin custodied with just a few people, so for example, a lot of the gold is custodied with just a few bullion banks, that centralization makes controlling prices a little bit easier, because then you've got physical on your one hand, you've got futures with the other, and you have a little bit more flexibility as a market maker to push prices around, etc. It's not apples to apples because of how decentralized Bitcoin is. It's easier to buy physical Bitcoin than it is to buy physical gold or silver. But I think that's why I say there's not any sort of this gauge, this point in time, in my view. It's more just watching to see how these markets develop. I don't think they're at the point yet where they're really controllable with futures. And a big part of that is because the biggest part of controlling gold, for example, is out of the unallocated gold market in London. The unregulated, if you will, expansion of paper derivatives, credit gold, over the last several decades has played a much bigger role than the futures market. And so there really is not an unallocated Bitcoin market, as far as I know, or other crypto market, as far as I know, in that way. To the extent you develop lots and lots of new coins, and those coins get interest, then that serves as sort of a market that draws demand away from, say, Bitcoin and Ethereum. in the same way that unallocated paper gold or credit gold would draw demand away from physical gold. But it's all a relative game. It's worked for periods of time in the past, I would say, but it hasn't, obviously, given what prices of Bitcoin and Ethereum have done. They've not worked in the long term. So that's the framework for how I think about it. There's no one answer to say, hey, here's what to watch for, and if that happens, it's more just sort of understanding the potential levers, and then if you see the potential levers, factoring that into your thought process. So that's going to do it for tonight. As always, thank you very much for joining me. If you like these updates, check us out at fftt-llc.com for more information about what we're up to and more information about tree rings. Our weekly piece gets a lot of great feedback, 10 most interesting things, and nice synopses on our thoughts on how they are impactful to the macro environment and your investment process. So as always, thank you for joining me. I hope everyone has a great rest of the week, and we'll talk with you all soon. Take care, everybody. Bye-bye.